All right, welcome to ICAN Intelligence. Today we're diving deep into IAS 27. We're talking separate financial statements. And look, we're not here to just memorize rules. The goal? To build a rock-solid understanding so you can walk into that exam and absolutely crush it. Let's jump in.
Okay, so here's the game plan for today. First, we'll tackle the big picture. Why does IAS 27 even exist? Then we'll get into the nitty-gritty, key terms, the core measurement choices, that's a big one. Then we'll look at dividends, disclosures, and wrap it all up with a sharp focus on the exam. Simple as that?
All right, first things first. Before we get into any rules, let's ask the most important question. What is the point of IAS 27? I mean, what problem is it actually trying to solve? Why should you care?
So, picture this. You've got a massive conglomerate, right? A parent company with tons of subsidiaries. You look at their group financial statements, and wow, the profits are through the roof. The whole family looks fantastic. But hang on, what about the parent company on its own? Is it actually making any money? Can it pay its own bills? That is the critical question IAS 27 is here to help us answer.
And this is where you have to think of it as two completely different stories. On one hand, you have the consolidated view, which is kind of like the big, happy family photo. That's IFRS 10, showing everyone together as one big economic unit. But then, IAS 27 gives us the individual portrait. It zooms right in on the parent company itself, and only the parent. It asks, how is this one entity doing as an investor?
So let's be super clear on the official objective. The standard is here to give you the rulebook, the accounting and disclosure rules for your investments when and only when you decide to prepare separate financial statements. This is so important. IAS 27 doesn't force you to prepare them, but if you do, either by choice or because the law says so, you have to follow its rules on how to do it.
Okay, we've got the why. Now let's build our foundation. We've got to nail down the key terms and figure out exactly who this standard applies to. Let's define the playing field.
And right here, in paragraph 4, this definition is basically the core of the entire standard. But look closely at what it says. It defines these statements by what you do in them. It immediately tells you that you have a choice. You can account for your investments at cost, under IFRS 9, or using the equity method. It's setting the stage for the big decision we're about to talk about.
So who's this for? Well, it's pretty straightforward. You apply IAS 27 if you choose to present these separate statements, or if you're forced to by local laws. But here's the key takeaway. The thing you absolutely cannot forget. These statements are almost always an extra set of accounts. They are presented in addition to the main consolidated statements, not instead of them.
Okay, deep breath. We're now moving into what is, without a doubt, the most important part of this standard. This is the core of IAS 27, and I can pretty much guarantee you it's going to be on your exam. The big question, how do you actually account for these investments?
So the standard lays out a huge decision for the company. It's an accounting policy choice, and there are 3 doors you can walk through. Door number 1, the cost method. Door number 2, IFRS 9, which usually means fair value. And door number 3, the equity method. But, and this is a big but, you have to be consistent. If you pick the cost method for your subsidiaries, you have to use it for all your subsidiaries. You can't mix and match within the same category.
And this table, honestly, this is your golden ticket for revision. It lays out the 3 methods side by side. Look at the subsequent measurement row. Cost is simple. You set it and forget it, unless it's impaired. IFRS 9, that's the complete opposite. It's constantly moving, remeasured to fair value every single reporting date, with the changes hitting your P&L. And the equity method is different again. It moves with the performance of the company you've invested in. Oh, and please, please, please look at that last row on dividends. The treatment is completely different depending on the model. That's a classic trip up in exams.
All right, exam mode activated. Picture this. You get a question, a whole scenario, but the examiner is sneaky. They don't tell you which policy the company is using. So, what do? Do you guess? No way. Here's exactly what you do to get top marks. You start by showing off your knowledge. You say, under IAS 27, the company has 3 choices: cost, IFRS 9, or the equity method. Then you briefly explain what each one means. After that, you pick one that seems reasonable, and you clearly state, for the purpose of this calculation, I will assume the company uses the cost method. By doing this, you're not just answering the question, you're demonstrating a deep understanding of the standard, and that's what examiners love to see.
Okay, let's take these rules and apply them to something really common, something we just flagged as a potential trap: dividends. What happens when that cash actually comes in from an investment?
Now, this is where a lot of students get tangled up.
but it's actually super logical once you see it. If you're using the cost or IFRS 9 method, when a dividend comes in, boom, it's income. It goes straight to your profit or loss statement. Easy. But if you're using the equity method, it's a completely different story. A dividend is seen as a return of your capital, not a return on it. Think about it. You're getting some of your original investment back. So it doesn't hit your income. Instead, it reduces the value of the investment on your balance sheet.
All right, so we've got the numbers down. But knowing how to do the accounting is only half the job. The other half is telling people what you did. And that's where disclosures come in. These are not nice-to-haves. They are absolutely required.
Think of this as your disclosure checklist, straight from the standard. You literally have to tick these boxes. Number 1, you have to flat out state these are separate financial statements. Number 2, if you weren't required by law to prepare them, you have to say why you did. Number 3, you need to list out your major investments, who they are, where they are, how much you own. And the big one, number 4, you must describe the measurement method you used. Cost, IFRS 9, equity method, you have to spell it out.
And listen to me on this one. This is a message directly from the people who mark your papers. They say one of the most common mistakes they see is students forgetting to disclose the accounting method. It's such an easy mark to pick up, and if you miss it, it just screams that you haven't been thorough. Don't be that person. It's one sentence, but it's a crucial one.
Okay, we've covered a lot of ground. So let's pull it all together now. We're going to build a simple, powerful checklist that you can use to structure your answer for any IAS 27 question that comes your way.
Here it is, your 5-step plan for success. Step 1. The moment you see the question, ask yourself, is this about the individual company or the whole group? You have to identify that you're in separate financial statements territory. Step 2. Immediately list the 3 choices: cost, IFRS 9, equity method. Step 3. Choose your policy and apply it consistently. Step 4. Deal with any dividends, making sure you follow the rule for the policy you chose. And finally, Step 5. Don't forget to nail those disclosures. You follow these 5 steps in order, and you'll be in fantastic shape.
So I want to leave you with one final thought, something to chew on that goes a bit deeper than just the rules. IAS 27 gives companies a choice between 3 very different ways of accounting for the exact same thing. So what does that mean? It means you could have 2 identical parent companies with identical investments showing wildly different profits and asset values in their separate statements. So my question to you is, what does that do to comparability? It's a really important limitation to understand.
And that's a wrap on our deep dive into IAS 27. I really hope you found that helpful. If you did, do me a favor and hit that like button, subscribe to ICAN Intelligence so you don't miss the next one, and drop a comment below telling me which IAS we should master together next. Thanks for your focus today, and I'll see you in the next one.